Yesterday we had a mixed day in the market with some very big names down, Nvidia 4%, Amazon 2%, but there were also other sectors that performed fairly strongly. But we want to draw your attention today to the fact that Medical Properties Trust has yet again cut that dividend. They've now announced an 8 cents per share of common stock to be paid on October this year. And what this ultimately means is that the dividend yield now comes down to 7%, which you may think isn't too bad. But bear in mind, as we will show you today, the dividend safety score still looks incredibly unsafe at the 10 level. We're going to discuss why that is. And in fact, for those that do want to note, it is a 47% drop this month. 3% on average over the last 5 years, the dividend has been decreasing. And if you've been holding this for over the last 10 years, it would have only gone up 1% year on year. Now we're going to take a look at all of these metrics, and also important to note that it was down around 3% yesterday. However, in the pre-market, it is only down around 1%. So it could be that the market has realized this was going to happen for quite some time, and maybe it will bottom out now. That remains to be seen. And today we want to do a quick analysis whether or not it is still an undervalued buy with the new yield that we have seen of just over 7%. Now we do know Quant does give it a sell rating, with both Seeking Alpha and Wall Street giving it a hold, and we're going to take a look at a lot of this historical data. However, we want to jump straight into today's episode, analyzing why their dividend looks to be very unsafe, and understand if we should have some major concerns if we are shareholders, and maybe it is a good buying opportunity if we want to add this to the portfolio at a potential low. Now, it was just reaffirmed in May that this score is sitting there at 10, very unsafe, and what this ultimately means is that there is a high risk of a dividend cut over a full economic cycle that we have just recently seen. So no surprises, and one of the reasons why we do talk about dividend safety on this channel consistently. And for those that are interested in knowing how they performed in the last recession, that is the Great Recession 07-09, they actually cut the dividend. No surprises there. They didn't increase it or maintain it. They had above average growth at -5%. Bear in mind that is above the average of the S&P, that's -12, but they did ultimately trail the S&P as well, -76, with the S&P coming in at -55. As we already touched upon, this is the dividend growth on average over the last 5 and 10 years, noting just that decrease that we have talked about today at 47%. So no surprises, not only 0 years of consecutive increases, but also 0 years for this REIT without paying a dividend without a reduction. Now, in terms of dividend yield theory, this is one that we always use on this channel. It talks about a company being undervalued when the current yield sits above the 5-year average. So we do have a signal here of undervaluation, but one word of caution with this company: the yield has been very high for quite some time and fairly unsustainable, as we have just seen over the last few and more recent dividend cuts. So not one we will pay attention in today's episode. Likewise, on the forward P to AFFO, 5.5, significantly below the 5-year of 13.3. This would mean a typical double undervaluation signal, but as we do go throughout this company today, you will see these aren't metrics we will use, and ultimately we will take a look at our own valuation of this company. Also want to point out though, the real estate sector P to AFFO does sit much higher at 14.6, so there could be a real question here of, is this some value now that we have seen the dividend cut, which ultimately we do believe is a good sign for this company. It was one that we were expecting for quite some time. Now, typically on this channel, we like to look at the free cash flow payout. However, bear in mind, for REITs, real estate investment trusts, it is a lot more volatile. So we'll draw your attention to the adjusted FFO, standing for the funds from operation payout, where we ideally want to see 95% or lower, especially for this industry, the medical building REITs. Now, one thing that is nice with MPW, it has been pretty much below that every single year, and the fact that now after the cut, it is coming to around 39% expected, we could be hoping for at least inflationary increases, which in fact for a yield of around 7% is a bad sign at all, especially if you believe in the longevity of this company. Now, we are just going through the metrics today. Do check out our previous episodes where we do a bit of a deeper dive on this company's financial information over the last few quarters, as well as some of their more recent activities. Now, in terms of the adjusted FFO, so essentially this is what we would look at for other companies in terms of the free cash flow, $1 in 2014, a lot of inconsistencies because ultimately we want to see growth steady over the longer term, and we see that drop into 2023. We also want to point out and be aware that over the next 12 months, it is anticipated to drop to around 82 cents. Then we take your attention and move on to essentially the sales growth on the right. For REITs, we want to see moderate growth, 5 to 10%, which you could argue was very strong up until 2021. Last 2 years, not looking great at all. The other thing we want to point your attention, on a trailing 12-month basis, it does sit at negative 78%. So do expect some of their numbers in the shorter term to show some signs where the top line is decreasing. And now we have talked about in previous episodes the issues they have had with some of their largest tenants, but they do look to be resolving that over the shorter term. AFFO per share growth as well, very important for REITs. We do want to see this increasing, as we will come and typically see from the below in a minute that the shares outstanding do increase at a fairly rapid rate. We do point out that over the last year, negative 34%, over the next 12 months, negative 4%. But ideally, do bear in mind this could be a value play, a turnaround play, as they have been hammered for quite some time, and management do look in the shorter term to be turning things around based on the activities they have recently done. In terms of total sales numerical, well, as you will have seen from the percentages, no surprises, the massive growth from 2014 to 21-22, but again, do note the drop in 2023, as well as on a trailing 12-month basis. And as we mentioned, with many companies, we do want to see them do share buybacks, reducing those shares outstanding, essentially returning excess cash to investor pockets, giving you larger portion of control of the company. With REITs, this isn't necessarily a red flag indicator. It is very common for them to dilute your position. The reason why they do this is because they retain a little of that internally generated cash flow after paying the majority out as dividends, something just to bear in mind, not just with MPW, but with REITs as a whole. This is something we see right across the sector, and even those popular companies like Realty Income, like Vici Properties, they will dilute your position at a fairly rapid rate. We then move on to ROIC, one of the most important metrics that I like when analyzing companies. 10% or more, or in fact for REITs 3 to 5%, give us faith management are able to effectively allocate their capital. They've done very well from 2014 to 2022, although we do note in the more recent year it has dropped, and on a trailing 12-month basis of negative 1%, that does mean on that basis they haven't turned a profit, something we can look at when we shortly take your attention to the income statement. And then we take your attention to the margins. Now, no surprises, very good margins right across the board, but with their decrease to their revenue, we also see the margin follow the same pattern, down from 66% to 11%, and we do note, as we mentioned, a loss that they will have made on a trailing 12-month basis at negative 54%. And then we finally move from the metrics to the net debt to EBITDA. Now, this is an incredibly important metric, not just for REITs, but also MPW. EBITDA referring to the earnings before the interest, tax, depreciation, amortization. Why we want to highlight this? Well, it correlates to both dividend safety and balance sheet strength. And as we can see, below 6 for medical building REITs, these are the number of years it would take the company to pay off all of their debt net of cash on hand, and below 6 is a very, very high metric. Typically for other companies, we want to see 3 to 3.5, and we do note it hasn't even been below 6 over the last 10 years. 9 of them have been above them, very high in 2023, extremely high as well over the next 12 months. No surprises at all while we have been seeing dividend cuts with MPW. Now, these are some metrics. Before we do continue, we also want to let you know that we have released our latest free weekly article where we run through super investors, what they've been buying, what they've been selling. You can get access to this as well as all these other articles by clicking on the pinned comment below and signing up and reading straight away for free. You'll also gain access to our 35 undervalued stocks for your consideration in the month of August, where we also talk about those that sit within our portfolio, so do check that out by clicking below. A few other things that we like to do on this channel. Firstly, insider movement, buys and sells. Well, 1.53% ownership, fairly small, with a very trivial amount of sales over the last year of 50,000, and as we can see, that was in quarter 3. Now, typically on this channel, for transparency, we will show the sales, even though we don't believe it to be a bearish sign, And on this occasion, we can see it was by the director on the 15th of August, so just last week, a very small amount. But also bear in mind, insiders sell for many reasons, whether that's personal or financial. The real thing that we want to spot here are insider buys, where we do believe is a very bullish signal, as ultimately insiders buy because they believe the share price will go up. We then draw your attention to the same, but for the institutions with around 72% ownership. We see around 333 million worth of sales over the last year, but ultimately we do see a very smaller amount of buys, so you could argue the same amount of buys as sells over the yearly period. But we do want to point out the main thing that in the more recent quarter, so Q2 of 2024, we see nearly double the amount of sells than buys by the institutions. Now do remember, always do your own due diligence and never copy what insiders or institutions do before executing on your stocks, but you can use it as part of a wider investment thesis. Now let's just circle back to the very first slide. Now we have seen over the last year, they are down around 33%. Over the last 10 years, if you have been a shareholder, also down around 67%. The worst thing that you could ever get from a return on investment over a period is getting negative return. And if you also factor into inflation, well, it would be even worse. The only thing we would say is when you incorporate dividends reinvested, it would be slightly better. Nonetheless, a horrific return by any standards. We do also note it is trading in the mid to lower end of the 52-week range, and the P to FFO looking very, very low, as we will come on to show you against the sector as well. Now the yield here is wrong, as we have already discussed. It now sits at 7% after the dividend cut. And we ultimately want to run through very quickly both the income statement and the balance sheet. We've already talked about the growth to the top line revenue, which looked very solid up until around 21-22 before the drop. And we have in previous episodes talked about how one of their largest tenants, in fact, had been struggling to pay off that revenue, and that has ultimately affected their top line. 2023 at 886, we can see on a trailing 12-month basis, not looking the greatest at 320 million. And our main point here is to show you the bottom line net income. What story does it tell you? Well, 50 million in 2014, up until 2022, looking very good at 903 million, but we do note both on the 23 basis as well as a trailing 12-month, a very large loss in comparison to both the other years as well as the top line, and a lot of inconsistency shown on a yearly standard. Then we want to take your attention to the balance sheet. A very good chance that we can see the health of the company, total cash versus total debt. 145 million of cash in 2014, around 607 million in that latest quarterly report. So it has grown, although fairly inconsistent on a year-on-year basis. And as we always like to mention, this number in isolation doesn't really tell us anything, which is why we always compare it to both the total debt numerically and directionally. And we can see that has increased 2.2 billion in 2014 to around 9.4 just in that latest report. And as we can see from essentially a graphical perspective, it has been increasing over long term. Not something we really want to see in any company we invest in, but we can use that as part of our margin of safety when looking at the valuation. Now we also want to draw out how they performed in their latest earnings against analyst estimates as well as forward looking. And over the last 4 quarters, not too bad, 75% track record, 3 out of 4 beats over the period. However, over the next 2 quarters, they are anticipating some massive drops to the EPS year on year. In fact, you have to go to quarter 1 to see positive, although very low single digit, as well as quarter 2. The other thing that we will draw out here is December 2025, 0.97 FFO expected. It will lower down the forward P to FFO, which is already at a low point, especially in comparison to the sector at 4.7. Then we want to quickly run by some metrics, explain what they mean, and the first one is the valuation, where they get an A+. Now, realistically, we typically do like to look at the P on a non-GAAP basis, and if you were to use that for MPW, it would show some massive discount to the sector. But at least we don't look to P to E. We like to look at something that's a lot more relevant, which is the P to AFFO, the price to adjusted funds from operations on a forward-looking basis, which tells us a very similar conclusion at 6.25, significantly lower than the sector of 16. So right now, if you are adding MPW to your portfolio, you are getting a 61% discount to the market, and that is pretty much whichever method you do look at, whether it's the P to FFO, trailing 12-month basis, or forward-looking. But do remember, sometimes it is warranted why companies trade at a premium, as well as why they trade at a discount. Our job here is to understand, is in fact there opportunities? Has the market overreacted? And can we see a very good signal to buy? Then we look at the growth. Well, they get an F, so the complete opposite of essentially the valuation. Whichever metric you use, you can see very, very poor, especially in comparison to the sector. So not really a great follow-up to what we just went through in terms of the valuation. And when we look at the profitability, well, here we get a D-. Again, not great. And in fact, the AFFO payout we already discussed does look healthy, especially after the cut they are having. And we can also see their cash from operations, 400 million, does look a lot better than the sector million, nearly double of 234. Now, just a quick conclusion for this part of the analysis: a double hold seeking alpha in Wall Street, a sell from quant, A+ on valuation, F on growth, with a D- on profitability. Now, before we jump into the analysis of the actual numbers and the valuation, we just want to remind you of how this company has performed on a total return. So this includes dividends reinvested, and if we can spot any themes in the healthcare industry, we have some very big competitors. I'm sure you've heard of quite a significant number of these. And total return over the last year, MPW has been the worst performing, negative 25%. That means you're getting that high yield and putting your money back in, looking very, very poor. Only one other company, SILA, that has also had negative return. So overall, the industry as a whole actually hasn't performed that bad at all. So we could say it is pretty much isolated to MPW. And when we expand over the last 5 years, what we note here, very poor, negative 64%. We do know a few others with negative return, with just 3 of them looking positive. So again, overall, not massively isolated to MPW, but in terms of the sheer poor performance of negative 64%, MPW the worst by quite some margin. And over the last 10 years, what we do note here, 2 of the 4 performing very poorly. That is SILA again, MPW negative 33%. That means you're reinvesting those very large yields, putting it back in, and still over a 10-year period, not looking great. Do remember though that past performance is never an indicator of future performance, and it could perform a lot better. In fact, it could also perform a lot worse. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of 644, how we got to this number? Well, we ran it through 2 relevant models that we believe for MPW. We have the dividend discount model where we can see the last 2 years looking very poor with negative growth. Then in terms of the average growth, as we can see, negative 18%. Now we do believe over the next few years, given the fact that they have cut it and that essential payout ratio has come down significantly, they will hopefully be able to increase it. We've gone for a fairly conservative look at 2%, and with that we get the intrinsic value above the market price, giving us an undervaluation signal. Bear in mind, we're not looking at any one of these models in isolation. The second one we have is the DCF model with the free cash flow year on year. We have the average growth rate of 95%. Forward looking, we have gone a little bit more conservative than analyst estimates, in fact negative 6%. And with the discount rate at 8%, we can see here the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we can see here the intrinsic value, our second undervaluation signal. Now bear in mind, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for MPW or any others. So our intrinsic value of 644, we always like to use a margin of safety on this channel where we use 10% at a bare minimum, and we execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, well, it is a buy at $5.79, and then we keep going till it's near the current trading price, 15% $5.40, add the 20% at $5.15, and we can see that there is quite a large MOS for this company, although you could argue it is fairly warranted. So we see 30% at around $4.50, which is pretty much its value right now, although with this news it could drop lower, or in fact it could go up, as the market may now see this as a very good sign for the health of the company moving forwards. In terms of Wall Street, well, they have a price target of $5.20, although this could change with the news, and they see upside of 15%. So 30% MOS, upside of 15%. For me personally, my thoughts are this isn't a company that I would invest in. The yield is a massive red flag. It has been cut twice already. The total return over the last 10 years, a lot of metrics that have been underperforming, just the bare minimums that we want to see. But on the other hand, there are investors who will see this as an opportunity. This could be a potential value play, and moving forward, maybe one that does outperform the rest in the sector. As always, do give us your thoughts in the comments below. If you enjoyed the episode, smash that like button, hit that subscribe button. Don't forget to sign up to the free weekly newsletter below, and also come join us in the Patreon if you want to talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.